So we had the budget on the 16th of March, and these are what I consider to be the main changes of relevance, direct or indirect, to financial planners. The first change was one that we were expecting, and it's effectively one of no change, which is no fundamental change to pensions relief. We know this is only going to be a deferment because the numbers are too big for it to be anything other than that. The deferment may be for quite some time though, we just don't know. It certainly won't be before the European election votes. What we have had, however, are some small technical changes on pensions, one of which is an interesting one and an important one, I think, really. If you're in receipt of a dependent's drawdown pension and then get to age 23, on the face of it, you're no longer a dependent, so can no longer continue to receive the dependent's drawdown. That was mad, and it's been changed. You can now continue to receive it. A few other changes of that nature, just to tighten up and make clearer some of the freedoms changes that were introduced, of course, in 2015. What we have, secondly, is a glimpse of what the future might look like and the sort of retirement savings plan that George Osborne may be attracted to in the shape of the lifetime ISA. So we haven't had a ditching of the past system or an introduction of a new system. What we've had is a kind of parallel introduction of a scheme that might attract the public's attention, which is, I think, is the way it's being positioned. So the lifetime ISA, basically you can contribute to it after the age of 18, but not over the age of 40. You'll get a government bonus, so it's a form of flat rate tax relief. For the contribution, you can contribute up to £4,000, and the government bonus will be another £1,000, effectively making it a 20% flat rate tax relief. You can extract the money, but not before age 60 if you don't want a penalty, unless you extract the money as a deposit for your first home purchase on a property worth not more than £450,000. Remember though, the extraction exacts quite a severe penalty. You'll lose the government bonus, you'll lose all the growth on the government bonus, and you'll have a 5% penalty as well. So if you want to avoid that, you need to leave the money where it is until age 60, or only withdraw it to purchase of house, or if you're in serious ill health. There'll be a bit of consultation because, of course, this new vehicle will not be available until 2017-18. Out of the blue came a change on capital gains tax. It's a simple one, and we're going to get it pretty much immediately. It will be in effect from the commencement of the next tax year, the 2016-17 tax year. And it's a very straightforward reduction of the highest rate of corporation tax, capital gains tax, from 28% to 20%, and a reduction of the basic rate taxpayers rate of 18% to 10%. So important, and it will impact on choices, especially investment choices, when you consider that together with the really important changes, which we already knew about, of course, to dividend taxation and the personal savings allowance, which of course also start from the 6th of April 2016. Still kind of on capital gains tax, we have a widened an expansion, as it were, of entrepreneurs relief to be available to people who are arm's length investors in unlisted securities. I thought we needed to give them to that, but there'll be some attraction there for even AIM-listed security investment. On SME taxation, owners of their own business, we've got corporation tax remaining at 20%, but dropping to 19% in 2017. And the announcement in the budget is it will drop even further to 17% in 2020-21. Point here is that government is saying, look, we're going to give you a low tax rate, but you will pay the tax. And we've seen significant further anti-avoidance provisions, mainly applied to multinationals. What we've also seen is the basically continuation of salary sacrifice in relation to pensions. So sacrificing your salary to have a pension payment in replacement for it is going to be okay. So no action against that, which was good. There is some action planned on loans to participators. So if you run your own business and withdraw money and don't characterise that money and designate that money as a dividend or a salary, then that money that you take, if it's not repaid by the end of 9 months, by the expiration of 9 months from the end of your accounting period, then that's going to be treated as a loan to a participator, and the tax rate that the company has to pay on that is increased from 25 to 32.5%. That's something to watch out for, and that payment cannot be reclaimed until you repay the loan or characterise the payment as a dividend or a salary. Lastly, of course, wouldn't be a budget without more anti-avoidance provisions. There's a 9 billion aspired to receipt from those anti-avoidance provisions, most of it coming from the profit shifting provisions against multinationals. The extensive use of losses by multinationals will be curtailed, but the expansion of the loss relief to individual smaller businesses will be welcomed, I think, really. So The disguised remuneration provisions are going to be toughened, mostly applying to past schemes. And as I've already mentioned, the loans to participator provisions are going to be introduced. So they're things that people will need to be careful about. Out of the anti-avoidance provisions, we just have a continued reaffirmation that boring is the new exciting. Stick to the trust, stick to the tried and tested, and you won't go far wrong. And there's plenty of that to deal with. All of this detail is on Techlink, in our budget bulletins, and in the follow-up through the publication of the finance bill to enactment. So watch out for that, give it a read, enjoy.